On today's segment, we're going to talk about some of the big mistakes that business owners make when they're dealing with attorneys. All right, today we're going to have a conversation about attorneys with an attorney, Zach Petersen from Dvorak Law Group. Welcome to the show, Zach.
Thanks, Dave. Thanks for having me.
In my business, I do a lot of work with attorneys, and I can come up with all sorts of brilliant ideas and strategies that business owners can use to create a succession plan, create an estate plan, but I always have to test it against the attorneys. And let me tell you, I have some good experiences at working with attorneys, and I have some really bad experiences working with attorneys. Zach is one of these good guys that I enjoy working with. I want to talk a little bit about attorney egos, maybe to get started.
I don't know what you're talking about.
Yeah. You have no sense of
sense of
that self-awareness on that.
No, none of that.
So one of the big problems that you have when you get into rooms with attorneys is they think they're the smartest guy in the room, and they're looking at you like you might be a threat because you're going to bring in some idea they didn't think about or some strategy they haven't thought about, and they're really worried about losing the client. So sometimes they'll hold it really close to the vest and not really be open with you, and they'll say, okay, they'll listen to what you have to say, and then they have no intentions of collaborating and working with you. And my experience is the guys that I've worked with joint clients that act like that, they do a horrible job at coaching and advising the clients. I mean, bad enough that even the basic stuff isn't done. And that might be why they are acting the way they are, because they know they're going to get found out that they haven't done the job that they should have done. So you're a good collaborator. When you walk in with a new client, let's say a new client comes into your office and they sit down and start to lay things out, what are some of the common things that you see that are mistakes or problems because the lawyers haven't done the right job? And I'm talking about with clients that have, estates of 10 million above, and maybe they run their own manufacturing company. What do you see when a client brings in and says, "Here's my files. Joe Smith has done my legal work." What do you look for first?
Well, from my perspective, I think you have to have a team. Certainly the bigger you get. I mean, a client has to have a team around them. I'm not an accountant. I'm not a financial advisor. I'm not an insurance agent. I'm not a banker. I understand.
I thought you were smart, though.
Oh, that's why I didn't do those things.
Yeah. Okay.
But no. So at the end of the day, you need to have a client who has a team around them that's collaborating and communicating with each other. Because if the accountant doesn't know what the legal work says, I see it all the time where, maybe there's 8 versions of an operating agreement, or transfers are happening, or gifts are happening, or there's different sort of action items that have been taken over the years, and either it's not been represented to the accountant, it's not reported properly on the tax returns. The amount of times I see a tax return not reflect the corporate documents is pretty staggering, to be honest with you. And
the consequences of that
they're material
is capital gain taxes that weren't accounted for properly. You could have gift taxes. You could have you could create estate tax problems because the people aren't thinking through what the consequences, the chain reaction is of what's been presented and implemented. Right?
Or the more common situation is there's just a box of files in some guy's closet that have no really order to them. I mean, at the end of the day, if you can put all the documents in place, you can have trusts, you can have operating agreements, you can have maybe the documents aren't bad in themselves, but the client has no idea what they signed. They have no idea the structure. They have no idea if it's what's best. They come in, they sign documents, maybe they meet once a year, but there's no organizational structure. There's no kind of documented, it's not easy to ascertain what's going on. And so, maybe the client understands it, but maybe his spouse doesn't, maybe his kids don't, maybe his partners don't. And usually until, they get big enough where they have to address the issues, or something catastrophic happens, then you've got to clean it all up. Somebody passes away, somebody gets divorced, name your situation, and it's just sort of a mess. So probably the most common kind of mistakes is the right word, is either lack of collaboration with other advisors and or just lack of structure in their actual documents and lack of understanding on the client side. Because from my standpoint, if the client doesn't know what they've got in place, if they can't understand, if they can't explain it to you, then I'm not doing my job as an attorney.
Yeah. So some of the things that I look for to see whether or not the lawyers have really done their job is if you see a client that owns 1, 2, or maybe multiple real estate projects and they're not in an LLC.
Mm-hmm.
I don't know how often you see that, but why don't you talk a minute about why, if you've got rental properties that you're using to create cash flow for you and build wealth, why do you want to make sure they're in an LLC?
Well, there's multiple reasons. I mean, number one that jumps out the page is liability protection. I mean, if you own a rental property or multiple rental properties and some liability event happens, which is not uncommon. I mean, certainly
somebody slips on the ice and
breaks their leg, and you get or breaks something worse, or dies, or or it's a residential rental for college kids and they have a party and something bad happens. Well, if you don't have an LLC or some sort of entity structuring or owning that property, who's liable? Well, it's the owner of the property, which is you personally. It's not the LLC. So the primary benefit is, or the baseline benefit is having some sort of an entity. So if something were to happen and they were to sue somebody, well, they're not suing Dave Nabity. They're suing Nabity LLC, which the only asset of Nabity LLC is the actual rental property. So
they can't get at your other assets.
No,
okay, so when do you go from having one LLC to maybe 2 LLCs, or to have a holding company that owns multiple LLCs?
I mean, that's not every situation's the same. I mean, it really depends on the client and their stomach for complexity or stomach for multiple kind of compliance measures. But I mean, going into talking about other advisors, that's why we want to bring in the insurance agent, the banker, get their opinion as well, because there's not like a set number. If you have three properties,
what's the advantage of having a holding company owning multiple LLCs? Let's say there's 7 of them.
Yep.
What's the advantage of doing that versus the client just dealing with 7 of them by themselves?
Well, I mean, ideally everything rolls up to one entity. So from a reporting standpoint, you can have one set of kind of QuickBooks, for example, and the holding company kind of handles and kind of, everything rolls up there. But that's another one tax return and another layer of protection. I mean, not only do they have to pierce the entity of the subsidiary that actually owns the property, they've also got to pierce the holding company before they get to you. And if you have a trust, you're creating layers in between.
If you have a holding company that owns 7, and the first one has a liability claim, can they get to LLC 2, 3, and 4?
Not if it's structured properly. No.
But that's something that an attorney could screw up.
Oh, absolutely. I mean, if you don't, and the client can too. I mean, but a lot of that is just not knowing the rules. I mean, for example, if you set up an LLC and then, the day after the LLC, you're still running everything through your personal checking account, well, that just creates more holes in the actual
in the event of an audit.
Yeah, in the event of an audit.
You could be in big trouble.
Or, a good litigation attorney, a plaintiff's attorney is going to see right through that and say, well, you set up the entity, but maybe you didn't title the assets properly. Maybe the rent isn't getting paid to the entity. Maybe the insurance isn't in the entity. So there's certain things that you can easily screw up. Just going on LegalZoom and dropping an LLC in place, maybe it works, but you have to have the back end. And that's where I think a good advisor comes into play, is making sure that everything is tied up.
Let's talk about something simple, which is a revocable trust. And you can have the piece of paper and you can have it in your file cabinet. But if you don't go and change all your assets into the name of the revocable trust, does it do any good?
No, honestly, it doesn't. I mean, maybe it could do.
I've heard of a pour over will that says that if I die, everything pours in the revocable trust, but that's too late, isn't it?
Well, certainly if there's beneficiaries in the assets, then it doesn't really matter what the will says. I mean, if you have a life insurance policy that goes to your ex-wife and your trust says it goes to your current wife, well, outside of some statutory scheme that would sever that relationship, it's going to go to your ex-wife, which is probably not what most people would want to have happen. I mean, beneficiary designations trump any will, any trust.
Well, let's say I've got a Schwab brokerage account, and it's in my name, and I have a revocable trust, and I really intended to change the Schwab account into a revocable trust, but didn't.
Yep.
But I have a pour over will.
It'll get there, but it's going to cost a lot more time and money.
It's still going through probate.
Oh, it's absolutely going through probate.
Yeah, the whole point of a revocable trust is to not have to take all your assets and take them through probate. Explain what probate is.
It's lucrative if you're an attorney, but what probate is just the process of getting assets from your personal name or your estate, effectively. So Dave Nabity owns...
you're going to see? You're going down to see a probate court judge?
Yeah, so Dave Nabity owns a house. Well, somebody has to own that house when Dave Nabity dies. I mean, we can't have a house that is owned by nobody. We have to have cars. Otherwise, we'd have cars, boats, houses,
floating around
with no owners. So the owner becomes the estate. And the amount of times I see, a farm, for example, that, grandpa died, nobody ever moved it out of his name. They just kept farming it. And, 20 years later, we've got to go back and open up an estate for grandpa who died 20 years ago and clean that all up. So probate...
that can take a while.
Oh, yeah.
And how expensive is it?
It can be expensive. I mean, it can be not expensive.
If it's a simple estate, it's probably not expensive.
Yeah.
But
and be leery also. I mean, talk about bad attorneys. I mean, to the extent that you are getting charged a percentage of the estate, I'd probably question whether or not that's the appropriate methodology to get billed by an attorney. That's a pretty common practice, but we don't do it, and I wouldn't recommend it.
Wouldn't you say that, like, one way you could see whether the attorney has not done their job is if they don't have a revocable trust and they have multiple and significant assets?
Yeah, that's one way, for sure. Or if they haven't updated it in a while. And
if they've got a bunch of assets, if they've got one, but they've got a bunch of assets and they're not titled.
Correct.
In the name of the revocable trust.
Yeah.
Okay. So let's talk about valuations and estate planning. You can set up a plan to give shares of stock to your children. And if you pick whatever value you want for those assets to be, or if you have a buddy, Fred, who claims he's a great valuation guy, and he puts a value on there that's something that you like, but if you came under audit,
good luck.
What are the consequences of basically understating the value of your assets as you've developed a plan to gift it?
Well, I mean, there's kind of, it depends on several factors, but to the extent you gifted an asset that, the audited value increased it enough where it actually triggered gift tax, well, that could be very expensive, hypothetically speaking. So,
when does, at death, who does, if you get audited, they'll go in and they'll mandate that you have to put all your assets to market value, right?
Correct. Yep.
And if the transaction that you did was below or way below market value, what does the IRS do to you?
Well, they adjust the value, and then your estate either includes those additional assets, or they could also argue it's an incomplete gift. They could argue you never properly reported the gift because there was not adequate disclosure, is what they call it, on the actual transfer. So if you gift, a closely held business and you don't have anything in the file, you just have you just say it's worth $1 million, but if you got an actual valuation, it's probably worth $10 million. And then when you pass away, it's worth $40 million. Well, good luck. That's all going to be included in your taxable estate. And the IRS is going to
subject to a 40% federal estate tax.
Absolutely. And, potentially penalties and interest depending on what was reported and when it was done. And it can be a problem, for sure. Because the IRS is, they mandate. Now, if you get a valuation done, generally speaking, you have some pretty good comfort that the gift you made would pass an audit. So part of what you're trying to do is not only survive an audit, but, file, with adequate disclosure and file in a way where the IRS is not going to be incentivized to go audit your stuff. Like anything, if you have a clean tax return, if you have clean valuation reports that are submitted along with that tax return, the IRS is generally speaking, not universally, but they're generally going to look at it and they're going to be less likely to pull up the audit. It could
be a big fight for them too.
Yeah.
To take a long time to argue that things are worth more than stated.
They flag files that look very suspect is what they flag. So to the extent you button it up, you file the return properly, you do it timely, you submit valuation reports, you hire a good attorney and an accountant to file it properly, I'm not saying you can't get audited, but if you do, you'll probably survive it. And your odds of getting or audited in general are pretty.
Okay, let's talk about irrevocable trusts for a minute.
Yep.
A common strategy to get assets out of the parents' estates is to gift those assets to an irrevocable trust. And today, both the husband and the wife can give away $15 million. So you can put $30,000 into your children's hands directly, or you can put them in irrevocable trusts. Why would you do the trusts as opposed to just giving the assets to the kids and go on your lovely way?
Well, there's multiple reasons. One, depending on how you set it up, certainly if you're married, you probably want some access, depending on your age as well. I mean, if you're a 60-year-old business owner and you have $30 million of assets, well, you probably still want some access to those assets during your life. So reason number one is you don't want to ask your kids for money going forward. You can set these things up in a way where either you directly have an interest, via your spouse, or somebody sets up a trust for your benefit, and we kind of move the assets around pre-funding.
Yeah.
Secondarily,
we were just talking about that, and what you've demonstrated is that if mom and dad are working together and they want to move assets to the children, dad creates a trust where mom can get a life income out of it until she passes. Mom creates a trust where dad can get a lifetime income out of it.
Yep.
They have to have their own trusts, and then they have to have the other be the income beneficiary until they pass. Then it would go to the children.
Correct.
So I would say one of the mistakes that I see people make is they go ahead and do these irrevocable trusts, and they call it good, and they don't think through splitting it into two pieces to where actually you can give the asset away. It's not subject to estate taxes. And then the husband and the wife can get income off of each other's trust.
Yeah, absolutely.
That's a big mistake if you don't do that.
Well, and you probably want the ability to modify that trust. I mean, irrevocable trust is sort of it can be a misnomer. It is irrevocable for maybe estate tax purposes. Maybe it's irrevocable for creditor purposes. But the other benefit, in addition to lifetime income, is you probably want the ability to modify the trust and have some control over those assets. If it owns a closely held business, maybe you don't want your kids to be able to make those decisions going forward. If you're going to sell the business, if you're going to hire and fire, or, just steer the direction of the company. And, maybe things happen. Maybe kids pass away. Maybe you have falling outs with kids. There's, addictions and divorces and, name the situations that happen just in the world in general. So mom and dad, the amount of times I see, irrevocable gifts made, which would include if you give assets away and retain a life estate. I'm not talking about irrevocable trusts. I'm talking about you deed your farm ground away and you retain a life estate. The amount of times I've seen that done, and clients come back and not really realizing that they no longer have the ability to sell that ground. They can't borrow against that ground. They can't change who the beneficiary of that ground is. They're just restricted, and clients don't know that.
That's something, folks, that I really want you to hear is irrevocable trusts are talked about by a lot of people, but there's ways to do them where you have flexibility, and there's ways to do them where you don't have flexibility. So that could be an area where you really get things screwed up. And so I want to talk about another situation that's kind of on the opposite end of it. We had a situation with a client where all that kind of planning got put together, and he got remarried after going through a divorce, and the new spouse didn't like all this stuff being irrevocable. And he was young enough that he lived with having the stock inside the irrevocable trust. And between the new wife not liking all those assets being stuck away from her fingers, and him being uncomfortable of having to go through the governance of managing things, they switched attorneys and did everything they could to unwind what was done at the beginning. When would you say people should maybe think twice before you do an irrevocable trust?
Well, I mean, think twice in terms of what your future life looks like. I mean, you don't necessarily know, what the future holds. But I mean, I know the situation you're talking about, and I would tell you, I still think the irrevocable trust was the right play there. I mean, you can't you can't solve for future spousal dynamics. I mean, that sort of is what it is. And part of that is, I think the structure was set up properly. And the structure, I think, if you got the guy in the room with some truth serum, would probably tell you he agreed with that. But I also understand.
You got pressure from the new.
Yeah, you got to live. You got to live with your wife, and there's happy wife, happy life, I guess is the analogy. So there's a certain element of that where
unless the happy wife means that you've got to give her millions and millions of dollars for her to be happy, and then you better hope she stays.
Yeah,
once she's got the money.
Well, there's that element as well.
But so if you build the trust right, though, you should have enough flexibility that you can just carry on doing what you were doing the way you were before.
Correct. I mean, I don't know that there's. I mean, the situation of whether or not.
What if you're an entrepreneur that wants to buy this company, buy that company, build this, build that, sell this one, sell that one? You want to just be a freewheeling entrepreneur, and all your assets are in this irrevocable trust where you can't take the core asset back.
Yeah. So I mean, even if you're a single individual who's not married, I mean, there's so much flexibility. Certainly with adjacent states. South Dakota is an important one. I'm from South Dakota, so maybe I'm biased, but Wyoming, Nevada, Nebraska is catching up, and other states are starting to catch up. But there's so much flexibility in these trust codes in these certain jurisdictions where you can essentially have a self-directed trust where maybe you're setting this thing up, and you can retain virtually all the management control with these entities. So if you're a wheeler and dealer, maybe you have a corporate trustee or an individual trustee who is the technical trustee on the agreement, but you're essentially making all the decisions. And you can set these things up with enough flexibility that if you get remarried in the future, if you have children, if you want charitable objectives, you can modify all of this and still be able to be that wheeler and dealer.
So there again, that's an example of where you got to have the right legal counsel to make sure you build this the right way. Mm-hmm. Okay, so I'm going to ask you some kind of crazy questions.
Go for it.
It's something that I struggle with the older I get. When does it make sense to have a trust that is perpetual and lasts forever?
Depends what your really objectives are. I mean, I think nothing probably ever lasts forever. I mean, even the Rockefellers of the world, that's probably the best example of some sort of a trust or a structure that continues on for a couple hundred years. But and maybe that will never sunset.
When does that make sense?
When does it make sense? Yeah. For me, it's hard to conceptualize, to be honest with you. I mean, I think that's part of it is people trying to create a legacy that is, I think part of that is maybe dealing with their mortality and trying to create a legacy that lives basically in a perpetuity, right? And they're trying to create a structure where, they're never forgotten. Now, me personally, there's a lot of big foundations. We're in Omaha, right? I mean, you got, Peter Kiewit and Sons
foundations are different.
Correct.
Right?
Correct.
If you put money in a foundation, that's different.
Correct.
But I have a real problem with parents that want to set up a trust that's going to take care of their children, their grandchildren, their great-grandchildren, their great-great-grandchildren, their great-great-great-great-great-great-grandchildren. Can you imagine growing up and knowing that a grandparent that you never knew, that you had no relationship or whatever, set aside $10 million for you, and you start to get access to it at age 16? How hard are you going to work on school?
Not very hard.
How hard are you going to work to get a job? What's your character going to be like? If you got all that money and then you just start living for pleasure, how long does that last? When does each pleasure stop end up being unfulfilling? So then what do? You start doing drugs, start doing alcohol. You might have promiscuity and start creating children and unwed situations. Nothing good, in my opinion, comes from children that inherit money and they don't have to do a dang thing to get it. I think it's a massive mistake. And here's let me just say one other thing. All the money that was on the planet when you were born was already there. When you die, it's going to be on the planet. So from the time you're born to the time you die, I think it's a God-given gift if you end up having money while you carry on. But this idea that you spend your whole life chasing money and building wealth so you can have this house, have this car, have this country club, have this condo in Germany, and all these great trappings of life. If you make that your motive and then you pass that on to successor generations, I think you are just making massive mistakes by doing that.
Mm-hmm.
So I'd rather see, if I die and I transfer assets to my children, I'd rather watch those children to see which ones are faithful and which ones aren't, and which ones are making good personal decisions and which ones aren't.
Mm-hmm.
If they pass that test, you put them in a position where they can handle the family wealth. But they ought to do that same evaluation with their kids.
Mm-hmm.
And if you're going to do it God's way, in my opinion, you make sure that money only goes to people that are faithful, and then it goes from one generation to the next, instead of going 5 generations out and you're creating huge amounts of wealth for people that aren't even born yet.
Mm-hmm. Yeah, I mean, what's enough, right? I mean, what is enough, and what is your incentive? You know, it's the trust fund baby kind of analogy. That
Yeah.
I mean, who really wants to have trust fund babies as their children? Probably not very many people. If you get,
I don't see anything good comes from it.
no, because if you didn't earn it, you don't respect it. I mean, the question, if I got $10 million dropped in my checking account on my 18th birthday, I don't know how incentivized I'd be when the alarm goes off at 6 a.m. to go to class. Probably not very.
Here's another thought too, is suffering has a way of shaking out of a person their pride, their ego, their desire for just living for pleasure. I think in some cases suffering is really good for a person.
Mm-hmm.
And I know it was good for me. You know, I went through the loss of a child that died.
Mm-hmm.
And I went through intense suffering. And the kind of man I was before I went into it was a lot different than the man I was when I came out of it.
Mm-hmm.
I changed for the better in many, many ways because I went through that kind of suffering. And I think it's a fundamental of life.
Mm-hmm.
If everything's easy, if it's all paid for you, and you don't have any kind of suffering along the way, the chances of you turning out to be a good human being,
mm-hmm.
I think, is pretty low.
Yeah.
So anyway, I bring that all up because parents need to think about that when they're building these estate plans.
Mm-hmm.
And if you get to a place where you have children that you know shouldn't inherit money, what are some of the things they should do with it?
Well, I mean, certainly.
Assuming there's no other family members to give it to.
Yeah, look at spend it before they die. That's always a fun way to do it. But if they're not doing that, I would say, charitable objectives.
Some people have been really great entrepreneurs,
mm-hmm.
and they build really great companies,
mm-hmm.
and they've been very faithful at building the company and taking care of their management and taking care
mm-hmm.
of their employees. And they've been a treasure
mm-hmm.
in the marketplace, but they have so much money they couldn't spend it.
Oh, absolutely.
So what do you do?
Well, I think that's the question, right? Because the problem with some of these individuals who do that, I mean, they're spending 80 hours a week for 40 years, and all they're doing is reinvesting in their company, their business, their employees.
They're making opportunity for people that work for them too.
And then they sit back at age 70 and say, well, what have I done? Where's this going to go? And maybe the kids, but what is enough, right? I mean, I was kind of going down the rabbit hole of, civic leaders in Omaha or whatever that looks like. But you look at, reinvesting in your community, and what does that look like? Whether it's faith-based, whether it's just community-based, whether it's, what is your passion, right? And what do you want that legacy to be?
Well, you can do good with your money
mm-hmm.
without passing it on to children that are going to be unfaithful with the money.
Oh, absolutely.
So donor advised funds.
Mm-hmm.
You want to talk about that for a minute? Charitable trusts.
Huge fan. Huge fan. Big fan. I mean, I think donor advised funds there's a reason that they're, I don't know the exact stats, but they have to be one of the fastest growing vehicles in the country.
Elaborate on the details of it.
Yeah. I mean, it's essentially, to make it very simple, it's a foundation without all the bells and whistles that go with the foundation and the costs associated with it. The idea is
there are a lot of costs. If you set up your own family foundation, it's expensive.
Well,
right?
I mean, just setting it up, plus the ongoing, you got to file a tax return every year. You got ongoing administrative requirements. You got to give 5% away every year. I mean, there's all these different sort of administrative burdens. Plus, when you're gone, somebody's got to administer this thing and got to run it. A donor advised fund essentially takes all that, administrative burden away from it, and you're putting it on whoever is the custodian of that, whether it's, a national kind of clearinghouse, a Fidelity, a Schwab, a Vanguard, or locally you have the Nebraska Community Foundation. You've got University of Nebraska has donor advised funds, Omaha Community Foundation.
Well, there's donor advised funds.
Everywhere.
If you're Jewish,
everywhere.
There's a donor advised funds that make sure that you're investing in the things that a Jewish community would invest in. There's Christian donor advised funds. I mean,
Everything.
There's all sorts of different options for that, and you don't have to build your own foundation.
Yeah, and you get an immediate share. I mean, so all it really is you would.
There's no estate tax on it.
Yeah, I mean,
you get a deduction when it goes in too, right?
Immediately, and you don't have to spend. I mean, so to the extent you need to use an immediate deduction, or you don't need to, but you want to for whatever reason, I mean, let's just say you want to give $1 million away, but you don't really want to know who want to go to. The whole idea is I'd set up a donor advised fund with whomever, and I'd contribute $1 million. And I get $1 million charitable deduction immediately for making that transfer. And then essentially I get to be involved with where that money goes in the future. So I can make an immediate charitable contribution. The money does not have to go out right away. In fact, you can spread that out over 10 years, 20 years. There's really no limit to how long it can stay in a donor advised fund. There's not the 5% rule. So you don't have to give out 5% every year. Now the big beautiful bill, I had some provisions or some proposals to try and maybe have excise tax on some of these things. But at the end of the day, it's a foundation that you can set up, with a relatively small amount of money. Most of them have a $10,000 minimum, $20,000 minimum. So in the grand scheme of things, not very much money. And you can essentially have a foundation for your family moving forward without those ongoing expenses. Your kids can be on the advisors.
Yeah, your kids can have influence in the community by being able to direct funds to different places. From the donor advised fund. All right, the last thing I want to talk to you about is an intentionally defective grantor trust. Mm-hmm. It's intentionally defective. What the heck does that mean?
It's a terrible name. I'll start off with that analysis. But
who came up with that?
I don't know, some estate planning attorney somewhere.
Pencil-necked attorney somewhere.
Yeah.
Okay.
He just marketed it and trademarked it. So essentially all the intentionally defective nature refers to is the income tax treatment of that trust.
Let's take a case.
Yep.
Let's put it on 9th grade. Okay.
Mm-hmm.
So you have a parent that wants to make a gift, and they also want to get assets out of their estate as fast as they can. Mm-hmm. And let's say they have completely used up their unified credit. So the $15 million for mom and dad, that entire $30 million has been given. But they've got more assets that they're trying to eliminate. Mm-hmm. Let's say it's a holding company that's got a bunch of LLCs that it owns. Mm-hmm. They can sell that to an intentionally defective trust.
Correct.
And let's say there's $1 million worth of taxable income coming off that trust.
Correct.
Every year, that trust has to pay tax on $1 million. But the trust is defective. Mm-hmm. Talk about what happens next.
Well, the defective nature essentially means that the trust might report the income, but the actual taxpayer is going to be the person who created the trust, the grantor of the trust.
So you're telling me I put those real estate assets into the trust through a note.
Correct.
And I got to pay the taxes?
That's correct. Yeah.
Well, how the heck am I going to get the money to pay the taxes? I just gave the asset away that generated all the income.
Well, for starters, if you sold it, which one benefit of it being grantor defective means the IRS treats the taxpayer for a sale as if it was the grantor, which means it's a tax neutral event.
So mom and dad.
Correct, which means there's no capital gains recognized on that sale.
Okay, but I got to pay taxes on $1 million because the trust is defective.
Correct.
Where in the heck am I going to get $400,000 to pay to the IRS?
Well, the good news is the trust probably owes you $1 million based off that transaction because you sold it to him. So there's a note.
So I sell it.
Yep.
And then I take back a note.
Correct.
Okay, now.
Make him pay the note back, a portion of the note. So that's
so they get the $1 million in the checking account in the trust. Mm-hmm. They send $400,000 to me, and it pays down the note by $400,000.
Correct.
But then I turn around and I send that $400,000 to the IRS.
Correct.
So it doesn't build up on my balance sheet.
Mm-hmm.
What's the bad part about that?
Well, the bad part is a cash flow issue, but as long as you've got a cash flow
As long as there's taxable income in the trust.
As long as you can plan for the cash flow, you can handle that. But, essentially view it as another tax-free gift. Because if you gave, yes, it's an irrevocable trust, which essentially means whoever those beneficiaries are in the future will receive that estate tax-free. In theory, if you're paying the taxes on that asset every year, well, that's essentially growing tax-free. It's not any different than like a Roth IRA or something that's growing.
Well, it's growing tax-free over here, but I got to eat the tax every year because I owe the tax on the stuff I just gave away.
Correct. Yeah. And hopefully,
so here's why it's a great idea.
Yeah.
In my book, this is nabology. Okay.
Okay.
Let's say it's a $10 million asset. Let's just say that, and I sell it to this irrevocable trust. But I got to pay income taxes from that trust. If that trust pays me principal and interest payments, I have the money to send to the IRS. So my $10 million note goes down to maybe $9 million. Next year we do it again, it goes down to $8 million.
Yep.
I don't have that money they gave me on my financial statement. So my financial statement's not going up and creating estate tax. That money that they gave me to pay down the note is gone, and it's money the trust would have had to pay anyway.
Correct.
So it's either gone and my estate doesn't drop, or they pay me principal and interest payment and my estate drops in value. So every year it goes from 10 million to 9 million to 8 million to 7 million. If you do it right, you can completely wipe out that note in a matter of 10 years with money that would have gone to the IRS anyway.
Correct.
It's not going to be over here. It's going to the IRS. So give it to me first, pay down my note, and then I'll give it to the IRS. It's the way to have an asset vanish.
Correct. Yeah, it's brilliant.
With money that would have otherwise gone to the IRS anyway.
Yeah, you owe yourself money, and then when you pay yourself back on the money you owe yourself and you give it to the IRS, you're reducing your taxable estate.
Yeah, it's an awesome way. Awesome way. So if you've given everything away, the next step is to sell an asset to an intentionally defective grantor trust. And if you have the cash flow, you're going to, again, for every dollar you take in, you're going to get 40 cents to the IRS. So why not give it to mom and dad to pay down their note first?
Agreed.
And then let them pay it to the IRS. Now, what are some of the missteps of setting that up that you've seen that you got to make sure you don't make these mistakes?
Well, you've got to report the gift from a gift tax standpoint. Well, if you sell it, maybe not, but you have to put a value on the gift for starters. So you have to somehow value what you're either gifting or selling. So if it is closely held business or if it's real estate, we talked about this earlier in the podcast, but whatever you value that at, you probably have to get an appraisal in some mechanism. So that's probably step one missed. Step two is, working with your accountant and making sure that you've, reported all these transfers, making sure that the gift tax return reflects what the reality of the situation is, making sure the income tax returns are updated to reflect all these transfers, and then going forward, making sure there's a separate trust tax return that actually reports the ownership and it all flows through back to the. So the biggest things I usually see are it's just more of the ongoing administrative component. And it sounds like a lot, but really once you get the hang of it, it's not that difficult.
One of my frustrations is if you get in a room and you talk about all these concepts, but you haven't modeled it. And that's one of the things our firm does is that we take all these concepts, we put them into real numbers, and then we show, here's what it looks like if you don't do any of this, and this is what your tax problems you're going to look at. Here's what it looks like if you do some of these things. And I don't think you can make a good business decision about whether or not you ought to adopt this kind of trust or that kind of trust or whatever without having this management information.
Yeah, I agree.
You know what I mean? Because if you don't see the pros and cons and the positives and the negatives of embracing any of these things, how can you make a good decision?
No, you can't.
And it just can't all be concepts.
Well, it's not cookie cutter, and you got to look at your situation. And is it a good fit for everybody? No, candidly. For a lot of people, it is. I would say for most people who have an estate tax issue, it is a good fit. But you've got to put you've got to overlay your actual facts on the circumstance.
Into the situation.
Absolutely.
And the before and the after tax scenario, what it looks like if you're doing option A versus B versus C. And that's the stuff that we like to do. to put things on the table so that when we get everybody around the table, everybody's got something to look at to see whether or not option A makes sense or option B makes sense.
Yeah, and you got to have, and I will say it provides you more flexibility, right? If you're not staring down the barrel at a $50 million tax liability, you can certainly still give a charity. You can certainly buy life insurance. You can certainly buy investments, but you actually have that flexibility versus if you don't plan, then you're reacting. You're not planning, you're just reacting, and you're kind of stuck in your situations. And more
sometimes it's the kids reacting, right?
Well, yeah, a lot of times it is.
Yeah, or the wife that hasn't been active in a business, and they're reacting too. Okay, Zach, where can people find you?
Zach Petersen. So Dvorak Law Group is the website. Look me up. You can Google me. I'm sure my email address, phone number, I can 402-933-9492. Call whenever.
Do you know any lawyer jokes?
I don't know very many.
Come
I hear them, but they're...
You hear them, you can't retain them.
Yeah, it's just kind of water off a duck's back for me.
I can sit.
You got a couple?
You ever seen the dad jokes?
Oh, yeah.
Videos?
Oh, yeah.
So I watch those things, and I laugh at this, and I laugh at that, and I swear that I'm going to remember the joke, and then I can't remember the joke.
Yeah.
And so I made the decision I'm going to sit down, and I'm going to watch these things, and I'm going to write the jokes down so I can remember them.
Yeah. They're good.
So I remember a few, though.
I've heard some good ones over the years.
So did you hear about the two cannibals that were on the side of the road eating a clown?
No.
One says to the other, "You think he tastes funny?"
Does he?
That's funny.
That's funny.
Don't you think that's funny?
That's funny.
Did you get it?
I got it. Yeah.
You got it?
Yeah.
Did you hear about the duck that got arrested?
No.
He was selling quack.
There we go.
Okay, that's enough of the dad joke. Huh? I know.
You didn't have the lawyer jokes.
I don't have any lawyer jokes.
They're hard to joke about.
Yeah. All right. Well, folks, that's it for this segment. Feel free to let me know if you got any questions or you want to chat. But thanks for being here, Zach. Really appreciate it.
Thanks for having me. Appreciate it, Dave.